I mean, I've been fired before. I've been laid off before, and I've quit on my own before. It's a lot better to quit on your own, okay? But I have seen the door slam in my face many times. I've maxed out credit cards. I've been worried how I'm going to pay for Christmas with things with kids, and I've been on the other side of this. But I always kind of had this belief that things will work out if you treat people the right way. And it's not lost on me when I was broke 10 years ago how lucky I am right now.
All right, Phil, take it away. We've got our really good friend Ryan Detrick, who probably has a great origin story of stock twits with Phil and I. We've got JC, who hasn't showered, otherwise he'd be flaunting single gelled hair. But I like the look. JC, I like this look. Are you in a hotel?
JC, Straza says Beach JC's way. He likes Beach JC better than regular JC. I don't know. It's nice here. It's good, like right? JC. The sun, think about it. The sun, the sand, the ocean water. Like, our kids do a lot of like magic stuff and princesses and all that stuff, right? Like kid stuff. There's always magic. The beach and the ocean is as magic as it gets in real life, Roman. Isn't that right?
It's so nice.
That's 5
it's
milligrams.
A lovely thing.
5 milligrams, boys. All right.
No?
I have been
lovely.
in...
the beach is great.
Gentlemen, this is a treat. We've got Ryan Detrick, who he's become a bit of a whore on CNBC, but we don't hold that against him because the guy's got to make a buck.
What do you mean he's a whore? What do you mean?
When you're sexy, you can pull that off.
This is a friendly show. This is a friendly show.
When you have ears like this, Howard, everybody likes you. What can I say? Yeah.
Listen, the nicest guy that's ever come out of Kentucky. Are you from Kentucky?
No. Ohio, it's all the same thing, though. Yeah, whatever.
Close.
Yeah. It's close. It's close.
Still the nicest guy that ever came out of Kentucky. And Phil Perman is wearing he saved his T-shirts, Ryan, from his kids when they were 8. Yep. And because he's in good shape, he pulls them out and flexes them occasionally. He took them. We have skinny jeans. Phil has skinny T-shirts. He's wearing one today. By the way,
just
Phil,
be jealous.
By the way,
a little jelly.
By the way, Phil, last fucking week, Pop was wearing a tie.
Yeah.
And your fucking shirt was inside and out. Your shirt, you were wearing your T-shirt inside.
Yeah. Didn't really care.
You looked homeless. All right. It's so good to have Ryan on the show. I pinged him last minute. This is an interesting market. I have very little to say, so I wanted Ryan to come on. Phil, take it away.
Ryan Detrick, Chief Market Strategist at Carson, and old dear friend to all of us here. How you doing, buddy?
I'm doing well. Howard hit me up on X yesterday, right before I was on CNBC, and said, "You want to come on?" I said, "Twitter.
It's fucking
okay,
Twitter. Right.
Okay, we'll call it Twitter then."
I love how you call it X, Detrick. I love how you do that.
Yeah, you know,
I still call it Facebook. Can't call it Meta.
Yeah.
Alphabet. Who calls it Alphabet?
Yeah. Guy. We pull him out of the street.
It is 618. It's 618 day, right? So I live in the 513 Cincinnati, but there's some Fibonacci numbers here in this T-shirt I'm wearing. I thought JC would appreciate that with the 513.
They're all Fibonacci numbers. I see you, dog.
See
I see you.
See that? It's a dual thing there. But
your question: what's more important, June the 18th or November the 23rd?
Well, I'd say November 23rd because it's probably close to Thanksgiving and everybody gets to eat a little more food, I guess. That's the only reason I'm saying that. But yeah, that one.
I always think
they're both great in their own way. Both great in their own way.
Okay. Do I need to step in? Are we talking about stocks? Do I need to step in, Phil?
So I just want to start here. And I just want to give you a shout, bro, because I remember in Q4 of 2022, we're all looking into the abyss. Everybody hates everything. The world is ending. And you're out there bullish on stocks. And I just want to give you a shout out, bro, and just take a victory lap for us because we all love you and you deserve it.
Well, thanks. Yeah, that wasn't the most popular call. But, honestly, listening to you guys and listening to some of the stuff JC was saying, where you had more new lows in June and not as many new lows in October. And then just the seasonality stuff that we look at, it's perfectly normal to have a major low in October. If you don't have a recession, I work with a guy named Sonu Varghese who's
midterm year, by the way.
Exactly. Midterm year Octobers. I work with Sonu Varghese, so I know hopefully a lot of people know by now. He's been on with JC before. He looks at the macro stuff. He was saying, listen, there's no recession coming. Slowdown, sure, but no recession. So The average bear market without a recession is 24.5%. We had a 25% bear market into October 22. And we just saw reasons to think it'd go higher, and then just real simplistic things, right? Keep it simple, stupid. I kind of live by that motto. I'm from Kentucky, according to Howard. I am Ohio, but nonetheless, pre-election years usually are pretty strong. Okay. I mean, we knew that. And you start we can get into a lot of stuff, but we were one of the few places that were optimistic last year. People hated it for a big chunk of, I'd go on TV and just get yelled at for being bullish, a big chunk of last year. We've been overweight equity. So I work at an RIA that manages about $36 billion, give or take, or total AUM. My team manages several $billion. So when I'm on TV, I'm not just a talking head. I'm talking about what the Carson investment research team has to say about the world, right? So we've been overweight equity since December of 22. We are still overweight equities right now. We can get into some of the weeds of that. We just still think that stocks are a pretty good place to be, and it's been a nice ride, but we don't think it's over yet.
Ryan, at the Carson Group, for what you do for your how you help advisors make decisions, what are the alternatives like? Like, so for example, you're talking about being overweight equities. Let's say you were underweight. Well, then what are you in bonds? Are you in gold? Are you in Bitcoin, ETF? Like, how do you think about the other stuff?
Great question there, because let's be honest, I work at an RIA. So are we ever going to go 100% gold? Probably not. I think it's pretty safe to say there. So, I mean, we know the longer term trends tend to be stocks do pretty well, and that's what we're trying to help your average investor understand, because over time that compounding really works. But JC, to answer your question, yes, we actually added a 3% allocation to gold in some of our tactical models. Let's see, is March of last year, so March of 23. We actually been very underweight bonds for a while, especially duration, the 2 years I've been there. But just about 2 months ago, we actually added some treasuries for the first time in forever. And we get into some of the inflation views and some of the reasons we think yields are going to go a little lower. We actually added some duration to bonds, but we're still underweight bonds relative to stocks. We got a little bit of cash, a little bit of gold in there. And, still we're sticking with some of the cyclicals, which I know have struggled lately. We can get into that. But we're still optimistic with no recession coming. That's going to be the place to be. But yeah, JC, I don't want to say vanilla necessarily, because we can do some more unique things. But, when we manage several $billions for clients, we just try to make sure that they understand, the path is stocks tend to do a little bit better. And when you don't have a recession, like we've been saying for a while, stocks probably going to do even better. So that's why we've been tilting equities over bonds in the models we run.
What kind of allocation? What kind of allocation would you consider underweight, right? So you're overweight equity. So what kind of allocation percentage does that?
Let's just stick with, I guess, 60-40. I mean, that's probably the easiest way. We manage about 16 different types of models. So I'll keep this fairly simple for the listeners. But 60-40, I mean, we'd be 5% underweight, maybe say 55% equities, about 45% bonds, or maybe 45% other stuff, maybe bonds, gold, some cash in there. Would we ever swing, more than 10% away? Honestly, get into the weeds of some of this, but some of the rules we have, we're not even allowed to do that, right? I mean, we're supposed to stick with kind of the guidelines, the ranges that we have. But again, we can tilt pretty good. I mean, I work for a guy named Bert White. I worked with Bert over at LPL. Bert is now our CEO. And one of the things Bert told us 2 years ago, told Sonu and myself and some members of the team is, listen, if you're confident on something, take a pretty big swing, right? We're a fairly new investment team. We're doing some new things. We're growing like mad here at Carson Group. And we took some pretty big swings, and we run unconstrained models, meaning you can go 100% equities if you want, right? And we don't necessarily do that, but we've been pushing 80-90% equities in those unconstrained models for a couple of years. I mean, our models have greatly outperformed their benchmarks. Go ahead, Phil.
Is that for all your customers over 90 years old? Or
well, if they wanted to invest in that, they could. Although I doubt if they will. That's up to the advisor, right? With whatever the advisor, we work with advisors, and advisors can pick where to put their clients. So yeah,
I know the Carson Group. I know where you worked at LPL. I think for young people watching, because the four of us all met on Stocktwits, tell people how you get into this career, because you've had a rocket ship. Tell people the struggle. Tell people, your passion of stocks and how you end up here being able to make decisions like this over, 2 billion, soon to be 10 billion. And, Carson Group, who I'm familiar with and talk to all the time, where this all goes. For people that are listening on Stocktwits, Tell them.
Yeah, so I worked at a small. I'll try to make this the quick version. I got the bug in the late 1990s in college. My dad gave me some play money. Quickly made money, lost it all because there was a crash. Right, I didn't know what was going on. I used leverage. I didn't know anything. But you live and learn. And I realized, oh wow, I could have made money on the way down. That's kind of interesting. And I was hooked. I knew that's what I wanted to do with the rest of my life. I worked at a research shop in Cincinnati for about 10 years, give or take. Newsletter. That's where I got my analytical mind. Didn't manage money, but I wanted to work more with people. I love presenting. I love talking. I love communicating. So I wanted to become like a market strategist or work somewhere. I worked on an RIA for like 6 months after I left that place, and they got bought out by Huntington Bank. So I was out of a job, and I was really struggling. I was looking for different jobs and things, and this is where I guess put a little more. And I started using Twitter, as we call it, Twitter back like in 2009. Because we didn't manage money. People forget this. You couldn't really get on Twitter if you managed money for a long time. So I had a first mover advantage.
Right, there was no compliance,
right,
and no
right. And now everybody's on Twitter /X, whatever you want to call it, but. That was the advantage I had. But then obviously we always had our first Phil moment. And I remember mine, Phil reached out and said, hey, we're doing this thing called, Stock Twitch. You should start using this. And I started using it and started learning. And I just was hooked with the way you could communicate and the impact you could have. And then there was a point in my career where I had literally no money because I was looking for a job and I was in trouble. I didn't know what to do with my life. And Howard, you hooked me up. And I know sometimes, I'll just say it like it is. You hooked me up. You flew me out to Stocktoberfest on either your dime or somebody's dime because I didn't pay anything. Got me out there, and I'll always appreciate this because I went out there, networked, and met people, and I met a top 50 LPL advisor. And he knew me, and one thing led to another. He connected me with Burt White, who was the head guy at LPL at the time. And after an interview, I'm hired at LPL now to be I guess I was started as a senior market strategist, eventually promoted to chief market strategist. After about 6-7 years at LPL, working with advisors, had a blast, made a ton of friends. LPL was big, it is big. I mean, they're huge, like 22,000 advisors when I was there, over $1 trillion. It was to the point where for my career, a lot of layers, a lot of things. You couldn't really get stuff done because it was a big company. That's fine. So I was ready for something new. And Bert actually left LPL to go to Carson Group, an RIA. And we got to talk, and he's like, you can make a lot more impact in the RIA channel than a big broker dealer. I said, okay. And it all kind of worked out that I started with Carson Group about 2 years ago as their chief market strategist. I will say this, I'm loving working where I am, doing what I'm doing. But maybe one more thing, because I think is what you wanted me to point out, Howard. I mean, I've been fired before. I've been laid off before, and I've quit on my own before. It's a lot better to quit on your own, okay? But I have seen the door slam in my face many times. I've maxed out credit cards. I've been worried how I'm going to pay for Christmas with things with kids, and I've been on the other side of this. So when people reach out and I see things, I try to always say, and believe me, people hate hearing this, but one door closes, another door opens. It is true, everybody, because I was that person. I wanted to punch anyone in the face that told me that, because when the door closed on you a couple times, it's not very fun. But I always kind of had this belief that things will work out if you treat people the right way. And I don't know if it's naive or not, but I've always tried to live that way, tried to treat people the right way. I'm sure I haven't always done it, but I think that's just kind of how I live. And I just love waking up every day, looking at the market, seeing what's going on, seeing what you guys are saying out there, listening to people, working with Sonu on our team and some other people on our team that are amazing, amazing people that care about nothing more than helping our industry, helping our Carson partners, and helping their clients. And there's more we can talk about, but that's kind of what I want to do the rest of my life, is wake up and talk about this stuff. And I'm doing it. And it's not lost on me when I was broke 10 years ago, how lucky I am right now.
Just a quick plug, Stocktoberfest is in effect this year. So
true.
If you are, and the people who are going to be there, there's going to be the big pros there. This
could be a panel. This could be a panel.
This could be a panel. And so we're having Stocktoberfest this year, October 20 to 22nd. Just Google Stocktoberfest or go to StockTwits. And if you're in that situation.
Phil, most importantly, if you're in that situation, I'm not doing free.
Sorry. I just told how many people I just told it's free, Howard. Sorry about that. Yeah.
You tell me yours wasn't a sob story. Here's the thing. Phil, JC, and I are very passionate towards people that are making the effort. What stood out about JC, I hooked up Josh and Barry at the first Stocktoberfest, who are now running $4 billion. Josh introduced us to JC. Phil and I met on Fred Wilson's blog. I think the pay it forward part is you can only pay it forward to people that are trying to be in the business. And if you're passionate about the markets like Ryan is or JC, if you're not writing, you're slamming a door in your own face, right? So the only way we would have discovered you is if, is you were sharing ideas or sharing, and you don't have to be right. I think young people need to remember that if they do like the markets, if you're staring at a screen all day, it pays to take notes. And if you're going to take notes, take digital notes, share them. Doesn't matter who's following you. But eventually people are going to look back at those notes, not your Zoom interview. So anyways, that's why I wanted to get to the story. There's never been easier to share Stocktwits, Twitter, Beehive, wherever you choose, right? But be consistent, be friendly. And you will never, I think the network effects will do their things. And you do get better from writing down about the markets. I mean, the stuff you share is great. All right, Phil, get into the markets for these
So we
two.
have a lot of mixed signals going on here, right? We have different things going on, and there's no two better people than Ryan and JC to sort some of this out. So I lined up a series of topics and charts that you could look at in different ways, right? That sort of go up against it. So the place where I'd like to start is just the popularity of momentum, right? Momentum and Bar Chart posted this the other day. Momentum trading is having the most success in history, even surpassing the dot-com bubble. So maybe Ryan, can you just tell us what we're looking at here and maybe your take on it? And then JC, we're going to come at you.
Yeah, I mean, well, hopefully it's fairly self-explanatory. It's the stocks that tend to trend have really been trending upwards, and we know right now who it is, right? It's some of the big tech names, but large cap tech and things that are doing well that are trending. MTUM is one of the momentum ETFs that we actually use at Carson Group, and we have that. But nonetheless, when you think about it, it's this is called Trends with Friends, right? I mean, I have a CMT. I don't have a CFA. I have a CMT, Charter Market Technician. Learned a long time ago that these trends can be in place a lot longer than you expect. And again, it's is it bubblicious here? I don't know. I mean, you could look at those pictures we're sharing there and think maybe a little bit, but breaking out to new highs is new highs. So it's an area that I think many people have kind of touched that stove one too many times, thinking that something's going to revert. Not just momentum, just in general, some of these large trends and they're still in play. And it's an area that we're more even weight technology. We are overweight communication services, though. So by no means are we underweight technology. I wish we were overweight, trust me. But nonetheless, it hadn't really hurt us how we look at the world. But again, it's when you manage money, it's hard to just say, let's go overweight tech. Tech's like 28% of the S&P. Maybe it's even more because it keeps going up. So, once you have that much, to go much more overweight can be a little troublesome to potentially, but again, we're a little more overweight communication services when you look at some of those high growth momentum names. I mean, JC, what are you saying?
Well, I think what Ryan started out saying is that stocks that are trending higher are leading the markets, and it's more just a function of the way the market behaves, right? We know momentum exists. We know that markets are not random, right? Like that was like a hypothesis that was proven to be incorrect, right? Markets trend, asset prices trend. I'd be a little bit careful with some of these momentum ETFs because the way that they, reweight and the indexes are always changing. So it's hard to compare today's momentum to, 30 years ago, 40 years ago. I think that's getting a little too cute. I think it gets back to, what Ryan was saying before, how, momentum begets momentum, right? Like that asset prices trend, like we know that, like, and that's happening. So it's perfectly normal, right?
It's confusing to me because this is what I do, right? And it's, now that I'm 60, I'm looking at this going, hey, I feel like Larry David. It's like you have this style, everybody makes fun of it. And because it's aggressive, and then
hold on, I want to say one more thing. Sorry, Howard. Those charts really speak to that because it's not so much momentum as it is the components in that momentum ETF are, you know what I'm saying? Like, is it really that momentum's doing so well, or is it that the stocks that are in that are?
Good point. It's just one chart, but what I would like to say is, I've joked that fundamental investing has never been less important, right? Because Floki's breaking out with NVIDIA, right? Like there's a chart that we shared last week or a couple of weeks ago, and I don't know what the tokens can go into a bear market 6 times a month. But, you look at a chart of Floki versus a chart of NVIDIA, plotted against its cash flow. Yeah, maybe overvalued, but makes total sense that it's going up in a historical framework of how you would value a stock, okay, and momentum. And then there's Floki, which has 0 fundamentals. Chart looks exactly the same. So we live in this world where I like to say that valuation, fundamental analysis means little than ever. And people jump at that and go, but Howard. And I'm saying, listen, Tiger, Andreessen, Insight, what's his name, the crazy Japanese guy, Masa, they were applying these same principles to illiquid assets, but 3 years ago. And history will look back on that era as probably being more crazy than 1999, because at least there was liquidity in 1990. Sure, it dried up very quickly and stocks fell 90%, but there was no room once you were in the Tiger private unicorn companies to get out. There was just no exit. These were just straight ass markdowns to port that. And I think that's part of why we're seeing momentum accelerate in the public markets, is people are realizing, yeah, we may be stupid, but we're not as stupid as Tiger and SoftBank and, Excel. Then 2021, we're writing billion-dollar checks into companies with no revenue, right? So I think there's just so much cash. You'll probably get to the next chart, Phil, that talks about the cash, but we've never been in an era where there's so much cash, there's so much information available to everybody, and there's so little fundamental analysis. And trend following just has always made sense, right? Things that are in motion tend to stay in motion. So, and then the fourth thing about those charts is, predicting when they end is almost impossible, meaning it's easier to come up with reasons why it can't continue, but I don't know. The trend is your friend. All right, next up.
So regarding that, perfect segue. And this is what I was thinking before you said that nobody knows when it's going to end. Ryan and also JC, what would make you theoretically underweight or bearish here? If it's not, and I agree, my take here on this chart, the S&P 500 momentum relative to S&P 500 is that it's illusory correlation. They point to 2000 and they say, oh, it's making a higher high, or it's up there where it was in 2000. Well, those are just two separate situations. So, however, what here would make you scratch your head, Ryan, and go, hey, you know what? Maybe we move to underweight.
Mm-hmm. Honestly, on these, I kind of momentum goes up. We talked about it. There's two things that our team really focuses on, probably more than anything. It's what are the credit markets up to, right? Credit spreads, triple B spreads, investment grade corporate spreads. If there's a monster under the bed, we're going to see stress in credit markets way before we probably see it anywhere else. Spoiler alert, we're not really seeing, they've ticked up a little bit in the last 2 weeks, but we're not seeing any major stress there. And then I also like to look at advanced decline lines, and we can get into some of this stuff because I think it's interesting. Various advanced decline lines 3 to 4 weeks ago made a bunch of new all-time highs. They've obviously been kind of breaking down, as literally the only thing going up has been technology. I mean, last week, tech was up 6%. Real estate was up 1%. Every other sector was down. If you look at the S&P 500, only 99 stocks outperformed last week, okay, even though the S&P gained 1.6%. So you've got this area where just very near term, you'd only have a couple, I'd say a couple, but not a ton of leadership going on. So if I see advanced decline lines breaking down and credit spread starting to blow out and increase a little bit, that would worry me. I mean, we're overweight equities now. Maybe that would be the first step to downgrade to more even weight equities. But we're not there yet, Phil. So those are two things that at the end of the day, if you said what two things can you focus on, I'd focus on those two things.
JC?
I mean, I agree with all of that. Credit spreads for sure. Market internals and things like that, most definitely. I would say in a more immediately, I would have to be able to pinpoint a group of stocks that would be the leaders to the downside in that bear market. Like, I would need to point to, like in 2021, all those ARC names and biotechnology and the Chinese internet, they all peaked in early 21. And those were the companies that dragged down the rest of the market. You saw that in the great financial crisis with home builders and financials. You had that group right? In the tech bubble, you had technology. Like, so who are the leaders to the downside, really, right? So consumer discretionary has been, one of the worst performers, even on an equally weighted basis. The bifurcation between the winners and the losers, the dispersion amongst consumer discretionary has been strong there as well. So perhaps seeing monster breakdowns in consumer discretionary and massive tops could potentially be that, but we're actually betting the opposite, that money's rotating into consumer discretionaries, and it's a place that we want to be in. So even in the groups that we think could potentially be those culprits, if you will, I know Ari Wald likes to call them that. We should have Ari on the show, by the way. Ari calls them that. Like, who would they be? There is no group that's dragging down this market right now. You've got underperformers, but you don't have like absolute losers that maybe the Dow transports. But again, I think we rotate into those transportation stocks. So even in some of the worst areas, I think there's opportunity actually.
And just as of Friday, so again, year to date, there's 11 sectors, right? 10 of them were up year to date. Okay. Now consumer discretionary, barely. Real estate down. So, you hear all over social media about this lack of breadth we're seeing recently. And there's some truth to it. We were hearing that also in late January. We were hearing a lot in late January about a lack of breadth. And there was, again, some areas that struggled, but it almost like the internals caught up with overall price, and given everybody all of a sudden as a technician and an expert on breadth, all of a sudden, it makes me wonder if we just play catch up once again with some of the internals. It started so far this week. We'll see. I know it's only 1 or 2 days, but so far we're starting to see that.
Yeah, because sector rotation is the lifeblood of a bull market. And while some parts of last year were thinner than others, markets kept rotating. At the beginning of the year, it was all tech and growth and the best first 6 months in the history of the NASDAQ. Guess what? Those stocks were not working in the back half of 22 when industrials and discretionary and other areas were working across the market. Those weren't, so they got rotated into. And in the fourth quarter, you saw further rotation into other areas that were not participating. So if now you start to see that rotation back into industrials, back into financials, back into consumer discretionary, that's that breadth expansion that we're talking about. But it's more sector rotation than anything else, which I think is part of the same conversation that gets lost in it. It's all about breadth, and they're forgetting about the rotation happening underneath the surface. Feel me on that, Ryan?
No, I totally agree there. I mean, like I said, if you look at the groups we like, we're overweight industrials and financials. And again, if I can use the F word for a second, fundamentals. Over the last 20 years, if you look at like PE multiples with using a Z-score, keep this fairly simple. Financials are really cheap right now. Okay. Industrials are fairly cheap right now. You know what's expensive? Tech, communication services. Not a surprise. And you don't blindly invest just on fundamentals. And I know this is a show about trends. I get it. But again, if you kind of like financials and industrials, those are some areas that are actually cheap right now. And again, if the other things line up, that to us suggests those are areas that, again, maybe the second half of this year, take back the baton a little bit. That's what we're banking on that way.
Yeah, we were talking here, Ryan. It was one of the 3 Gs, Goldman and Google. Goldman is so cheap in the sense that they spent 15 years chasing tech and fintech and trying to be everything. Neobank, lender, Apple. I think they're running with Apple as there are going to be more run-ins. The fintechs are going to run into Apple. You look at PayPal. Like, there's a lot of non-momentum in this market because the big guys continue to suck momentum away. The reason momentum's working in big cap is your profits are their planet's profits, right? Like, so Apple announcing, its deal with a firm sucks more of the life out of PayPal and Square. Right. While they may seem big and people may love their product and Toast, Apple's coming for it all in the banking sector. But who can't they come for? For sure as hell, Google and Goldman can't play with Apple. They didn't make any money off that relationship. But you know what Apple can't do? What Goldman does, capital markets. And as Goldman gets back to being a capital markets player, the chart looks great. Momentum looks great. I'm buying the dips, selling the rips type thing. We were talking about here in the high 3s, but like it has a tremendous amount of momentum, and I consider that a financial interactive broker. So financials are working. I agree. All right, Phil, what else?
Yeah, so we're going to take a look at JC's chart. We were talking about industrials versus consumer discretionary here. And the only comment I have on this discussion is the art to momentum and regression. So you guys, we're talking about both momentum and regression trading at the same time. We're talking about, okay, we're trending. We have all this momentum. It's incredible that ETF is making an all-time high. But at the same time, you're looking at underperformers for them, for signs that they're catching up, which I just love that. So there's really a lot more. It's really a lot more nuance there than just, okay, get on the Mag 7 trade.
Yeah, and I think, understanding the absolute trends is really important too, because when you're always comparing something to the S&P 500, remember, there aren't any tech stocks in the industrial sector. There aren't any tech stocks in the energy sector, right? So if you're comparing it to the S&P 500 that's loaded with tech stocks, and tech is an outperformer, of course, those are going to underperform. It doesn't mean that it's bearish though, right? It's just, it's hard to keep up with the leaders if those are very, very strong leaders. So looking at things on both an absolute and relative basis, I think makes sense. And then also when you go through these cycles enough times, like we have, obviously, you'll notice that in every single one of those, you get sector rotation. That's how markets work. So why should we expect anything different this bull market? Like, this is a perfect example. So here you're looking at the Dow Jones Industrial Average making new highs and the transports diverging for quite some time now. And, when you study market tops throughout history, you see this sort of thing. So, of course, it calls into question, what are transports telling us? Well, maybe it's not what are transports telling us. Maybe it's what is the Dow Industrial Average telling us, right? And the transports will be playing catch up. So, I think it's important to play devil's advocate and think of it from both ways. So what if we do get that rotation into transports and confirm what the industrials have already been telling us? The way I learned it, right, Ryan, a mutual friend of ours, Ralph Acampora, he said, JC, don't fight Papa Dow. And you know what I used to do a lot when I was little? I used to fight Papa Dow. I used to think I was so cool because the S&P 500 and the institutions follow. Don't fight Papa Dow. He was right all along.
Yeah, I'll just jump in on that. So just, we've got data on the Dow going back to 1896, right? Long time. And I took a look at when the Dow makes new all-time highs, because we can talk about leading indicators. We can talk about ISMs. We can talk about yield curves. We can talk about all these different things. We've been told by all those bow tie economists for 2 years why there's a recession coming and a bear market coming, and it hadn't happened. But when the Dow hits an all-time high, again, let's go back to 1900, like a year later, you go into recession like less than 1% of the time. I mean, the best indicator we have for the stock market, for the economy, my personal opinion, is likely the stock market. I don't know if that's a self-fulfilling prophecy or not, but the fact that we're still flirting with all-time highs.
It's a discounting mechanism.
Yeah, we've made 31 all-time highs on the S&P, assuming we close higher today. Let's call it 30 for the year, whatever. That tends to be one of the better signs that we have. I'll never forget 2 years ago right now, May of 2020, right? Stocks, or April and May, stocks ripped higher, right? In the middle of COVID, some of the worst headlines we've ever seen, yet the market was going higher. Everybody's scratching their head. Why? It's because, maybe the market saw, maybe things weren't going to be as bad as we thought. Maybe the Fed was going to flood the system. Whatever it was, the market saw that. So the market is smarter than all of us, and new highs tend to be a signal that the economy is not going into recession in the next 12 months. Just put it like that.
One thing we should all get used to is no matter what the economy is doing, the headlines will get worse. I mean, it's the TikTok generation. Ad dollars spent on TV are going this way. Ad dollars spent on influence are going this way. That does not lead to, what are influencers going to do to get ad dollars? They're going to say whatever they're not professionals. They're going to say whatever whether they believe it or not. As ad dollars flow out of television, what are the remaining TV people doing? We see what they've been doing. They've been polarizing further and further and trying to steal users from each other with more polarizing figures. So everybody, I call this everybody's Tucker Carlson. And if everybody's Tucker Carlson, there will be a recession every day, according to somebody. The truth of the matter is the economy's so big, and there's so much cash, as Phil showed on the sidelines, that there's just rolling, there's rolling recessions, basically. What we viewed as a recession before is different because our kids have Venmo. lucky enough, some parents can just, you've got the boomerang kid. So it's much harder to read the economy, which could just be another reason why people are trend following. So again, these all are so interrelated, but really good thoughts from you guys. All right, Phil, what else?
As a corollary to that, don't trust what you read. Like, there's nothing trustable now. Like,
why read?
Why read at all?
Talk to your friends.
The beautiful thing about what Ryan and JC both do is they just look at data, and they really don't derive that much. It's just pure what it is. It's like what Ryan just said. Hey, the Dow Jones Industrial Average makes a new all-time high, and a year later, by historic standards, we're higher, and we're not in a recession. And it's just simple math. It's just looking back at history, seeing is it 100%? No, but it's just simple over and over and over again. So then you turn on the TV or you go on Twitter and you just see people saying insane shit. Everybody's Tucker Carlson. It's a great line, Howard. And it's like, there's nothing, there's nothing there of value whatsoever. Ultimately, I think
I will say, dude, I mean, there's fans of Tucker Carlson that call me all the time and say, watch it. And I did. Somehow he had on the quarterback for the Green Bay, what's his name? Who's insane. Oh my God, who's now an expert on foreign affairs too. The old
Aaron Rodgers, and he's the quarterback for the Jets, Howard.
Whatever.
Still green.
Okay. I had to hear Tucker Carlson had, be prepared for. I saw 3 minutes of it that I can't unsee.
The dude got traded to the Jets and broke his leg on the first fucking play.
And
it's classic.
And no wonder he thinks that the government is going to put chips in our heads. So, anyways, the fact that world affairs are being talked about on Tucker Carlson and that guy, and that this guy who has every privilege in the world thinks that America's coming to an end, or get used to this. These are people that are not momentum investing. These are people that are telling you that grocery stores in Russia are better than your local store. And literally, he said yesterday, in a few years, we're going to have social credit scores here, and you're not going to be able to shop at the supermarket you want unless you're a good person. These are things coming out of the mouths of leading voices so prepare for the headlines to get worse. That's the only thing I know in my soul, is to try and shrink my world down to people and prices that will keep me not insane. So,
and to be fair, there's idiots and liars
part
on
of the
both
explanation.
Sides. And to be fair,
I wasn't saying a side there. I was just pointing out two idiots that I ran across. And we know Tucker Carlson, he sold his soul. But, he's entitled to have whatever guest he wants on. But to hear the nonsense spewing out of these people in a world where we have all this opportunity is crazy.
Okay,
crazy.
So we're going to go back to one other regression potential play rather than momentum potential play. Ryan, I'm going to hit you with this. You recently came out bullish of small caps, which I hear nobody else saying at all, anywhere. And so it's, I think, well worth our time to let you walk us through how you're looking at that.
Yeah, we like small and mid caps. For the year, small caps are flat, mid caps up 6-7%. S&P is about double that. Now, believe me, small caps have struggled. It's frustrated a lot of people. The last 2 months last year, the Russell 2000, with JC was talking about that big fourth quarter with the rotation. The Russell 2000 was up about 24% in 2 months, November, December last year. That was like the best 2-month rally ever. I took a look at the 10 biggest 2-month rallies ever for the Russell 2. A year later, higher, like 20-something% on average, and higher like every single time. So again, maybe we're consolidating after a record 2-month rally in small caps, but a little more color on this. You talk about small caps, people hate them. Rightfully so. They've struggled. We get it. But it's, if everybody's thinking alike, somebody isn't thinking. General Patton, maybe there's an opportunity there. And to us at Carson Group, we look at the inflation data. You don't go off the wheels a little bit for trends and friends, but there's actually a trends in inflation that people aren't talking about. Groceries are down 4 months in a row. New car prices down 5 months in a row. If you look at CPI, restaurants have come back. Restaurants are like 3.5% year over year. That's where they were in 2019. I don't want to get too in the weeds in this, but Sonu and I do a lot of this stuff. There are signs under the surface that yes, core CPI has been stubborn at 3.3, 3.4 for a long time. Under the surface, there are signs there's some big improvement coming. What in the world does that mean to us? Well, this is why we added. Again, we're still underweight fixed income, but we switched around our duration. We got out of some high yield, which did really well on that side, and added some treasuries about a month and a half, 2 months ago, because we saw some signs that said, you know what, inflation is going to improve here. What does that mean? Big deal. Inflation improves. What's it mean to the market? What's it mean to people trying to invest money? It means likely we're going to see lower yields. We think yields will peak for the year. We've seen yields start to go lower. 435 is a big level. For the 10-year, we're beneath that. 2-year yield obviously has been going lower, so shorter end. So the market's not buying the Fed's bluff, where the Fed came off hawkish, saying they're going to cut only one time. Market didn't buy that. We don't buy that. We think there's probably 2 cuts coming. And again, yields go lower. And what in the world does all that mean? Well, potentially that can be a potential driver for just more dispersion, more broad participation, specifically small caps and mid caps. And I mentioned last comment on this, we look at 20 years out, 2 standard deviations. What's going on with valuations? Well, small caps relative to large caps. Small caps are the cheapest they've been since 1999. Okay. That led to a 13-year period of outperformance. I'm not saying we're going to have a 13-year period of outperformance, but I'm saying that there's a lot of kindling there. If we get any positive news, and again, I think it's going to be one more solid inflation print, which we are expecting, that can be a rotation into small and mid the second half of this year that a lot of people are not expecting. But that could just be the next phase of this overall structural bull market we think we're in.
Mm-hmm.
JC?
Beautiful.
Yeah, beautiful.
Listen, I think that if we've learned anything about the stock market is that the bond market, the stock market just doesn't want bond market volatility, so the range bound kind of lackluster environment that we've been in has been a tailwind for equities. I think it can continue to be, if rates have peaked for the year, as long as they're not completely collapsing and we're not getting this monster flight to safety in treasury bonds, with real rate of acceleration there, I think stocks would find it it'd be more favorable if things would just stay messy and range bound in the rate market. I'll add to the, what Detrick was saying about lower rates. You've got Canada, right? They lowered rates.
ECB did. ECB for the first time since 2019 cut rates recently. Yeah.
Yeah. So things are happening globally. I guess we'll see what happens. Again, if you're looking for that rotation, whether it be in financials or industrials or consumer discretionaries, an interest rate market that's muted and not really having these massive swings and strong directional moves, I think that's good for that rotation. I could see, lackluster rates, small caps really doing well. And by the way, zoom out in the chart of the Russell 2000. Yeah. It goes from the lower left to the upper right, guys.
Right.
Long-term uptrend.
Mm-hmm. Yeah, can I add a few thoughts? So I know I sent around the private markets too, because we do like talking about momentum. I shared it with you and Kiki a few minutes ago.
We threw that in there. It's in the doc. First time fundraising activity, right?
Yeah. Let's talk about America's phenomenal. So again, I think like I said, I've never seen things more clear. It doesn't make think that my returns will be better, but I've never seen things more clear. We've talked about it here. We have a luxury economy, degenerate economy. Hate it, like it. I'm just telling you what I see. We had a bubble to end all bubbles. Worse than 1999. It just happened in the private markets. Your mom and dad didn't see it. If you look at this chart, I'm in this space. I'm embarrassed for what I saw. And I wrote about it from 2017 to 2021 with SoftBank and the SoftBank copiers. History will go back and maybe they'll rewrite history and say Tiger was trying to corner the market and be the S&P ETF of private markets. It didn't work. And from that, you see the chart here, right? You had this blistering the 2020 dip because of COVID, and then people realized they weren't going to die. The money printer went on. Everybody became a VC right at the top in 2021. Unlike learning how to trade, the misdirection of those private markets, which I loved, is incredible. All those people from 2014 to 2021 did not learn one thing about investing. They were fake investing. They were taking LP money, putting it in long-term deals under the auspices of ZERP, not understanding one thing about the market. In 1999 to 2000, we all learned what a stop loss was, what asset allocation was. So we have a generation of people that don't even know what the stock market is. And now they're going to be working for free. As you can see that dip there from 21 to 24. Those people can't get out. They're working for free still, despite them allocating money right at the top. You can't just sell. You're dealing with shit. So what I have seen clearly is 2024 to late last year when we were writing a lot of checks, and Ryan's seen in the wealth tech, he's seen a couple of our products. There's never been a better time to write seed stage checks. So there's never been a better time to be a momentum investor. There's never been a better time to be out of certain parts of momentum. And there's never been a better time to build a business because no one's watching, right? If you stay at the line of sight of Apple, Google, if you come in with the idea, I'm going to upset those people, you're thinking about it wrong. If you come in the way where I'm going to think about building a business organically with the tech that I have at my service that last bubble gave us, there is so much opportunity right now. But I will tell people, stop reading headlines, get yourself off TikTok, at least on the mobile apps, get yourself off headlines and start following people that look at price and look at correlations. And I think I said this before, Ryan, CMT is the new CFA. Even as I joke about, of course, fundamental analysis matters. But what matters more is how price action works and how intermarket works. So I think the CMT, as poorly run as an organization as it may be, that JC's had one forever, and I think that's the first time I heard that acronym. CMT is an incredible, thing to learn.
So I've had my CMT for 20 years. I got mine in 2004. I think I was the 499th person to get one. And, I was like, do I want to get a CFA? Do I want to go CMT? Worked at an option shop, short-term trading, using sentiment things like, it made more sense for me to get a CMT, and I'm thankful. Now, I will be honest or clear about this. It sometimes was not always great for my career not to have a CFA, not to think like everybody else, not to always look up balance sheets and PE multiples and earnings, but to actually look at price momentum and seasonality and sentiment and all those things that I look at now. And thank God that's how I look at it, because I don't look at the world like your average market strategist that's on TV talking about these things. I look at hopefully a whole different spectrum, and I'm with you totally, Howard, that when you're managing money, there's a lot of ways to do it. But I absolutely think just looking at relative strength and certain things really can help you. If you're ignoring it, you're just behind the eight ball.
Yeah, because a lot of these forms of analysis, I'll just chime in quickly. A lot of these forms of analysis are about what the market should be doing, what the market could be doing, when technical analysis focuses on what the market is actually doing.
Yeah.
Anyways, a little tip there for people, a roundabout way that if I can do it, anybody can do it. I've tried every form of investing, but intermarket analysis and really taking a step back, really cherry picking who you follow, understanding your own behavior. The four of us around the table have these conversations, which are never going to be viral, but are very helpful to me. Looking at the intermarket like I see at private markets, right? It's, as confused as I am about this momentum, I'm not going to fight it. But as confused as I am about the private markets, it's still never been a better time. A lot of it just has to do with how you attack these things. And for people that don't know what a CMT is, look it up. We've been saying this for a very long time. Think about doing that. That'll make you a better investor, and it'll make you obviously more interesting at cocktail parties than a CFA. So it has everything going for it. And I didn't know it had been around that long, so kudos to you. And do you feel like, you missing something by not looking at fundamentals?
Well, let me put it this way.
At the RIA?
No, I don't think I'm missing much because I work with a guy named Sonu Varghese who lives in the data, lives in the macro world. He puts together incredible notes and things. It gives me enough bullet points to be aware if I'm on TV with Centola yesterday, I got to talk about whatever, macro things out there. Trust me, end of the day, I think momentum and technicals matter a little bit more than fundamentals, just what I think. But again, I'm pretty well versed in the fundamental world if I have to be. And I do find it interesting. I mean, I never thought I'd like talking about the Fed or inflation or some of that stuff, honestly, 15, 20 years ago. But it is pretty interesting. And some of it does all kind of come together. And at the end of the day, a market strategist like me, I'm not a pure technician, right? I'm a market strategist. I have to tell stories. I tell stories. And my job is to take the complex data, make it easy for people to understand. I present all over the country. Last week, I was in California for a few days. Then I was in New York City for a few days. I mean, I'm all over the place. And the best advice, the best compliment I get is when a little old lady comes up at the end of my conversation, my presentation, whatever, and says, you know what? I have no idea what you just said, but I really liked it. That's what I'm trying to do is tell stories and help people understand what's happening out there. I'm not always going to be right and I always going to be wrong, but I'm using data to show where we were. Just quick example. I want to make sure this gets out there. We had a good May. Okay. S&P gained over 4% in May. What in the world does that mean? Usually May is not that strong. The rest of the year is normally higher and up an average of 10%, a median of 13%. That's way better than average. It's just one data point. I get it. But when I stack all these different data points on top of each other, and I share them all over the place for free, honestly, a lot of times, they continue to suggest that this upward trend we've been in is still alive and well, guys.
You can go to Google and just Google Detrick Carson Group blog and subscribe to that because you get so much. And Ryan, you just mentioned inflation. I know we were talking about it earlier. I do want to cover a little bit more if you guys have a few more minutes, because the other call that you made recently is a really important one. I know we were talking about the volatility of rates before, and I agree with you guys. It's super important. It's like, what's the, how fast are we moving in one direction or another? And if we're just kind of meandering within a range, to JC's point, we don't care as much. It's a little bit more benign because there's nothing, there's no unexpected event. But you made a call last week, I think. When was that article? I think it was it was the 13th.
What did I say? I can't wait to hear what I said.
Inflation is headed lower. Mm-hmm. And that means rate cuts are coming. Mm-hmm. And so the thing that I love about that is it's declarative, because if you turn on, to Howard's point, you turn on the TV, you go on the internet, and depending on what happened that morning or what the latest data point was, people are freaking out in one direction. Oh my God, it's inflation. Or in the other direction. Oh my God, it's going to be a recession. And it's like, all you have to do is flip a coin. But you're making a call and you're not a coin flipper guy. Mm-hmm. So why don't you just tell us a little bit about this lower inflation call based on data?
So at the start of the year, we're hearing 6 or 7 cuts. We always said, wow, if we have 6 or 7 cuts this year, that probably means the economy is really slowing down. We weren't seeing signals the economy is majorly going to slow down. And then about 2 months ago, we're actually hearing people talk about rate hikes. There's going to be no cuts, rate hikes. We said, that's the pendulum had swung way too far. And that's why, again, in some of the models we run, we moved a little bit of high yield into treasuries. For the first time in 2 years I've been here, we've never touched treasuries. We just thought that pendulum, Phil, swung way too far, and now we're starting to see some better inflation data. And again, that's why treasuries literally had their best week of the year last week, and bonds, the ag, your average bond fund was down about 4 or 5% not that long ago. The ag's up on the year now. I'm not bragging about being up on the year when we know stocks have done a lot better, but hey, at least you're getting something out of bonds here all of a sudden. But I'll put it like this: the worry that we hear is if the Fed starts to cut, and let's be clear, the Fed hasn't had the best record when it comes to inflation. Remember, transitory behind the 8 ball. If they cut, maybe inflation soars. Now, I'll make this quick. We think one of the big, here's a new trend. Here's another trend we haven't talked about. We think there's a major trend in productivity in our country. If you look, productivity like the last 2 decades averaged like 1.5%. What in the world does that mean? That's really low. The last couple quarters were up around 3%. This is something Sonu's talked a lot about. We think we're on the precipice of a lot of positives on productivity. Why is that? Because everybody got a new job 2 years ago. I'm a perfect example of this. Everybody got a new job. They're actually staying in their jobs. They're happy where they are. So people are being more productive. There's some other things going on that are leading productivity, AI and these things. If we're on a cusp of another 5 years or so of stronger productivity than we just saw last decade, what does that mean? The last time we had strong productivity like this was in the mid-90s. The mid-90s, what happened? Alan Greenspan cut a little bit in 95. We had strong productivity. We didn't have a soaring inflation after they did some surgical cuts. And what also happened? Well, remember what happened? We saw higher wages, prior productivity puts a cap on inflation. With those higher wages, the economy continued to grow mid to late 90s, really strong, and the economy did well, or stock market did well. One final thing, if usually GDP comes in a little bit lower than what they thought at the start of the year, that's just how it works, except in periods when you have stronger productivity. Mid to late 90s, every time it started the year, GDP was whatever number it was, it came in higher like every time. Last year, nominal GDP in the U.S. was over 6%. Okay, that's more than China. Nobody thought our economy was going to grow like that, including us. We were kind of bullish. We didn't think it'd grow like that. But because we had stronger productivity, what I'm saying, a cherry on top, a trend for friends here. If we continue to see better productivity numbers going forward, that's a really good sign. It lets the Fed cut a couple of times. The economy is still strong. Wages can remain strong. And there's a lid on inflation.
Howie?
Okay, I'll give you, just four productive guys here, but let me give you a little personal story. It's the opposite of what Ryan said, because Ryan's talking about actual numbers because he's done the work. Use your eyes and ears. We've never been in it's a two-pronged thing. Like, we've never been in a higher productive market and a lower productive market. I look at my daughter who loves to work, loves her job, got screwed in her COVID years because she wanted to be productive. But guess what? Working from home, no mentorship, overpaid because the companies make money. They don't know how to track these kids. These kids are watching Netflix. Right. So there's this lost productivity. We're not even counting the lost productivity of these first entrants into the job market that aren't getting proper mentoring like you did. They're not getting doors slammed in their face. They don't even know what to do. Okay. But then there's the other side of the world. The 60-year-old. I was supposed to be retired. I have coffee. I have Adderall. I have weights. I have fitness. I have lifestyle. I have knowledge. I can work 4 jobs. Elon Musk is running 4 multi-hundred million. We joke about him. I like to joke. I'm an angry prick, but there's nobody in human history that's been able to do this. So again, it depends who you look at. You've never had a better opportunity to be more productive. You've also never had a better opportunity to look at the wrong news, follow the wrong people, and be the most miserable, unproductive human being on earth. We're seeing it in America. We're seeing it in parts of the Middle East. So again, a lot of this comes down to your own personal attitude and your choice. You can go to Instagram and be miserable. You can go to Instagram and follow comedians. You can go to Instagram and follow fitness. And you can go to Instagram and follow, lifestyle, right? Improving your life. So you can train the algo to do what you want it to do. I just think most people are not picking the right mentors and training those. So the productivity part is really important, because it's never been a better time to be an investor. And therefore you have to align yourself with productive people, productive thinkers, and productive assets. And this is the best time of all time to do that. So that's the interesting thing about this market. Go ahead, Phil.
We're all out of time. We're not going to get to like 5 things, but Ryan D, love you, bro. Literally.
Yeah.
Old school.
Great job.
Last word.
Last word. Thank you guys. I'm sitting here because, Phil, you reached out many years ago. Howard, you've helped me a lot. We're always connected. I'm always here if you need me, but just thank you to you guys for everything you've done for my career to make this. Howard, the reason I'm a media whore because you got me out there. Now it's your problem. You did this. You created it, Howard. I'm like Frankenstein. You can't turn me off now. I'm everywhere. But honestly, love what you guys are doing. Love this new podcast. Honored to be here. And I don't know, just thanks for everything, guys.
Yeah, the podcast is fun, right?
Yes.
Like, it's fun to just let our friends speak. You're very good at the media, John. I mean, I was mentioning about Josh last night. I'm watching he's just so savvy at this. I'm not savvy at media. I just don't but the way you've evolved and be able to, like, you and JC especially. Phil, We didn't get to Health Corner, Phil. One tip.
One quick tip. So here's the thing. It's the longest days of the year right now, and it's very hot, especially in the Northeast. So what you do for the next 2 weeks, get out early. Go for an early hike. There's no time more gorgeous and beautiful in the day than sunrise or just after sunrise. So get out there, go to bed early tonight, get yourself up 5:30 in the morning, find a friend, find a dog, find anybody, and just get outside and move your body. Go for a hike if there's a place, if there's a park within a couple miles of where you live. Go to the park, get out there early, go for a little hike early in the morning. The beauty of it is that you get your exercise in for the day. You're back by 7:30. You take a shower. You're ready to go before the market open. It's beautiful. Get out there early in the morning for the next 2 or 3 weeks, especially while it's hot and especially while the days are longer than 15 hours.
Yeah. All right, boys. Ryan, you look a little bit thinner too. I think I noticed that you're. Are you working out?
Trying to. I don't know. I was in California last week. I ate too much food last week, but I'm trying to. Yeah.
1 week's fine. All right, boys. We'll do it again. Phil, thanks for running this. Ryan, thanks for joining us.
Adios.
See you guys. Thank you.